Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the conventional fund business for the week ended May 24th, 2017. That's a Wednesday time period that we're measuring. And we'll talk about ETFs later on, but we'll first initially talk about basically conventional fund business, what happened into flows there. Basically, we saw about a $3.5 billion outflow from the conventional fund business. And this is on the heels of a pretty dour week that we had a week ago Wednesday when we saw the market take a big dive. And despite actually hearing some fairly good news, about the economy. Basically, we saw the Philly Fed manufacturing index climb. We saw initial jobless claims actually decline to about 4,000, and we saw oil prices take a hike up. And actually, S&P and the Dow actually had 5 consecutive days of plus side performance, which we haven't seen since last February, February 2017. So we saw investors actually take a breather and step away, just not knowing which way the tide is going to turn with the woes that have been going on in Washington recently. But we had good news in the European economy. Basically, we saw that they've had some growth indications that indicated that their growth was at a kind of a 6-month high. And I think that took investors not by surprise, but gave them something else to think about, and we'll see how that panned out. Let's take a look at our individual macro groups to see what the flows were on a macro group basis. We saw that equity funds saw about $6.2 billion in outflows. Taxable bond funds took in money, but only to the tune of about $600 million. Community bond funds saw about $300 million of net inflows, and money market funds, I guess, were the big collector, about $1.7 billion. Well, let's take a look at equity funds to see how what I was describing, how that played out in equity fund flows. We saw some pretty big outflows for the week. Despite having a 1.67% return for the week, and the second week in 3 that we've actually had plus side performance, again, we saw outflows of about $6.2 billion. It's the 9th consecutive week that we've seen outflows from equity funds. And how it broke out is we saw domestic equity funds actually take it on the chin, about $4.9 billion in outflows there. It's the 21st consecutive week that we've seen outflows, and this is despite a 1.95% return. If we take a look at the non-domestic equity funds, we saw about $1.2 billion in outflows as well. It's the 3rd consecutive week they've seen outflows. And this was on a 1.11% return. So again, investors were kind of taking their foot off the pedal just to see what's going to go on. If we take a kind of a macro group look out at that and look at the subsectors, actually, we see large cap funds being the pride of the group once again, about $2.5 billion in outflows. And then we saw global equity funds actually lose about $1.7 billion. On the international front, we saw about a $500 million inflow. So investors were, again, that European zone, the Eurozone growth rates, probably drove them to do more international investing, take their foot off at anything that had anything related to the United States or global investments, not domestic equity funds. Let's take a look now at the ETF universe to see how that played out. For the first week in 7, they seemed to agree with the retail investor. We saw authorized participants withdraw about $3.9 billion from the from the ETF fund business on the equity side. And where we saw the big inflows was a little bit in line with what we saw on inflows into the conventional fund business. We saw the iShares MSCI EFA taking about $0.8 billion, and then we saw the iShares MSCI Brazil capped ETF taking about $500 million. So people were encouraged to basically invest in the overseas investments and really skip out on the U.S. funds, and that certainly played through. We saw the iShares Russell 2000 lose about $1.8 billion, and SPY, Spider S&P 500, lose about $1.6 billion. Let's take a look at the fixed income universe to see what happened in that arena. For the 6th consecutive week, we saw inflows, this time to the tune of about $600 million, as I was saying. 2nd consecutive week, though, we've seen plus side performance this week to the tune of 0.30%. Corporate investment grade debt funds actually saw the biggest inflows, but only $0.7 billion, and it's the 25th consecutive week that they've seen inflows. Treasuries, government treasuries, we saw had about $125 million in inflows. That was the next biggest collector of assets. Now, when we take a look at corporate investment grade debt funds, I always like to talk about a subset that's in there. It is our loan participation funds. Loan participation funds basically saw about $194 million in net new money come in. Not a big number, but it's a 28th consecutive week that we've seen inflows into loan pars, and the same trend we've been seeing in our inflation-protected securities group as well. So why don't we now take a look at basically, just wanted to mention also high yield funds actually saw the biggest outflow as people, again, were taking a risk off approach. They saw about $221 million in outflows. Let's take a look on the ETF side of the fixed income universe to see what happened there. For the second consecutive week, we saw inflows, this time to the tune of $1.8 billion. iShares iBox investment grade corporate debt funds actually took in about $657. iShares Core U.S. Aggregate Bond Fund saw about $370 million. And on the bottom side of this, we saw the Spider Bloomberg Barclay High Yield Bond ETF lose about $279 million. So certainly we saw ETF investors take a little turn of heart, basically go after yield. So they weren't going after treasuries or shorts. They're basically going after the intermediate investment grade, and it certainly stayed true. And they took their foot off the pedal off the high risk areas, so we saw high yield outflows. Let's take a look now at muni bond funds. They've been on a little run for themselves, about $344 million in inflows. 7th consecutive week they've seen net new money come into that group, and it's the 2nd consecutive week we've actually had plus side performance. This time we saw about a 0.25% growth for the week. That's pretty good for muni bond funds. National muni bond funds actually took in the lion's share, about 399. About half of that was made up, if you take a look at it, high yield. But that means that we saw, and this is the 7th consecutive week, by the way, that national munis have taken the money. That means a little bit of the single state munis actually saw some loss. And basically this comes down to the issue that occurred a week ago Wednesday, when people lost a little bit more confidence in Washington and the President Trump administration. This is one of the issues that people are talking about. If they can't build any coalition, they can't get the Republicans and the Democrats to agree on some of these tax cut proposals, people are afraid that it's not going to be quite as beneficial. So they're going back to muni bond funds, at least for now. Let's take a look now at money market funds. Money market funds for the 3rd consecutive week basically saw inflows, about $1.7 billion this week. And how it broke out, taxable money market funds saw about $1.9 billion inflows, while tax-exempt money market funds saw about $210 in outflows. However, we take a look at the taxable bond funds, we see that the institutional investors, and that's actually you and I in 401ks and those type of things, but also truly institutional, put money to work in money market funds, about $3.9 billion, while the retail investor actually took out about $2 billion of money from the coffers of money market funds. Well, that's it for me, but we had some interesting news come out today. Real GDP basically revised up to 1.2%. From 0.9%. That was a big plus. And where we saw the benefits is in personal consumption and also in business investments. And so we're going to see how that plays through in next week flows. If I haven't touched the areas that you wanted to cover, you could actually go to www.lipperusfundflows.com, or you can join us not this week, but the following week. Both of us will be off on vacation, so we're going to have a week pause here. But you can come back and talk to one of our analysts or see one of our analysts talk about the flows trends of the week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.